Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm the senior trader for the Forex Super Model, and this is the Technical Issues series, part 2, Why is Scaling so difficult? Now, what do we mean by scaling? Well, scaling trades is really the process where you, so if you look at the default, let's just use the long for ease of demonstration then. So if you're looking at long trades, then you've got an entry, you've got a TP, take profit, and a stop normally for the default trader. And so the standard trade would be, say, 1 unit. So you've got one unit coming in at the entry, and with risk management, you know, all the rest of it, that would be maybe no more than 1% of your account, etc. as a day trader. So you've got this structure, if you like, and we're talking about scaling here. So your initial entry would be maybe 1 unit, and then let's suppose the market. So let's get rid of that. I suppose the market starts to go your way. So let's suppose we get a. So that was our initial entry. And then the market starts to we're going long, and it starts to go up very nicely for us. Thank you very much. And then we decide, well, really we'd like a bigger position. So how do we get a bigger position? Well, obviously we have to add more trades, and this is where the difficulty starts, because obviously our entry was lower here, so we're going to get a worse entry as we add more trades. So what most people do is they want some sort of pullback. So they're looking at this sort of situation. So that would be their ideal second entry. So this would be a second entry. And their initial entry might be 1.0 units, and they might add another unit. Obviously, that may well fly in the face of their risking no more than 1% of their account, but we'll talk about that a bit later. So the ideal situation to scale for the default trader would be in a long position, would be the market rising, then they wait for a pullback, they get the second entry in nicely at the pullback, and then the market starts rising again. So and then they think, well, we're not just happy with that, we'd like to scale up a bit more, because we're obviously right, where the trend's in our favour, we've got higher highs and higher lows, etc. So we're looking at getting in on a third at at another pullback. So let's suppose we've got a pullback there, and we get a third entry in. We get a third entry of 1 unit, and then the market starts going up again. So we're punching 3 units now on the up. Everything's great. This initial entry is obviously at the lowest level. Then we've got a medium level second entry and a worse level third entry, and that's sort of like, that's what we tend to mean by default scaling. So you start off with a smaller trade, and as as it goes your way, you enter further trades. Now, obviously, you can do that in reverse. So this would be a short trade. So you'd be waiting for that would be your initial entry. You'd be waiting for a short pullback. So in other words, the market starts to retrace on the up, and then likewise there. So that's the sort of default trader's dream scaling scenario. Now, there's many problems with that, obviously. Life isn't as simple as that in the markets, and as I come back to this title, why is scaling so difficult? Well, if it was like this, obviously it wouldn't be difficult at all. It'd be plain sailing, and everything would be great. But there's numerous issues with that approach that are going to cause you problems. Now, the first issue is as I say, your account size. If you're a strict 1%er, then in order to have any scaling trades, you've obviously got to go in relatively lower. You've got to go in at less the equivalent of 1% of your trade. So if you're looking for, say, 3 or 4 scaling trades on top of your initial trade, then your position size has only got to be 0.25 or 0.33, a third of your initial entry. So that's one thing. So and the problem with that, of course, is that if you're unable to scale, you're then suddenly in a trade which is a quarter or a third of the size of your usual trade size, and it ultimately it won't make it'll make a quarter or a third of your usual take. So that's one obvious problem. The other way around it possibly is to go in at your normal level, and then the market rises, you get a pullback, and you go in again, but then you're going to start to violate your 1% rule. So what you could get around that by, you could move a break-even stop on that. So effectively, you're in that situation where you've nullified the downside to a degree, and then you're up and running. So your break-even stop would be sort of, around your entry, obviously. So you're effectively in a way getting around that problem. The problem with that, of course, is that you're vulnerable to chop, and the chances are you're going to end up with your initial trade may be taken out of break even, and this trade will be taken out at a negative stop. So you'll end up making a loss on a relatively profitable trade. So that's one problem with it. And then obviously as you scale, so let's assume we do the initial entry and it starts going our way, and then even if you're clever enough to recognize the pullback to within a few points, and you get your second trade in, and then the problem is if this trade starts to turn around on you. So maybe initially it goes your way, so you've got 2 trades running, and then maybe it starts to turn around on you, which is the usual familiar pattern. And the problem with this is you're not going backwards 1 trade now, you're going backwards 2 trades. So suddenly your profits, which were quite nice on the initial entry, are being eroded at twice the rate because you've scaled at this point, which has now turned round on you. So, and likewise, if you manage to get into a third trade, so we've gone up and we've got in at the retracement, we've gone up again, and then we've got a retracement and we've got in here, then we're running 3 trades, and if this one starts to retrace on you, then you're in the position where you've got 3 trades running downwards. So you're going downwards at 3 times the rate then, and it doesn't take long for you to for you to go to your break-even point overall. It's only a matter of far fewer points because of the fact that you're now running 3 trades the wrong way instead of the initial one. So and that argument can be obviously transferred over to short positions and just reverse out what we've been saying really. So this is the reality of scaling in a way, in a default style manner. And this is one of the reasons why it's so difficult. There are numerous reasons. Obviously, your initial entry was based on presumably some sort of sound, analysis that you used, or it filled a criteria, a pattern, or your indicators were flashing green or whatever, and that was fine. But your scaling trades are unlikely to have exactly the same reasons for going in. The scaling reasons are going to be probably inferior to the initial entry for most traders. So you're in a position where all you're really saying is that we still believe this is going to trend up, say if we're in a long trade, and we're just getting in where we think this retracement has had enough. So that is your secondary and third scaling trades arguably are based on inferior analysis. They're purely based on the fact that your initial trade is running with you and we're in an uptrend if we're long, and therefore that leads to a problem in many respects, because psychologically you're not as strong in those secondary and third trades, and arguably any time you scale at a worse initial entry, which you obviously do if you're going up, then you're mentally vulnerable to the problem of it's going against me, and not only that, it's going against me at twice or 3 times the rate of my initial trade. So that's really not very clever for most traders, and that's why another reason why scaling is so difficult. It sorts you out very quickly, and also you get this frustration effect of why didn't I just stick with the initial entry, because I'd still be nicely up now. Whereas you're probably, if you're up to a third trade here, you're probably out the whole trade sort of midway here because of the nature of the pullback on the 3 positions. So that is another problem. Right, so that's why it's so difficult. How can you, what strategy can you use to try and help yourself out really? So, well, what do we do at the Forex Super Model? Well, if you remember on how to trade the Forex Super Model videos, which if you haven't seen are worth looking at, we have a period where we want to be wrong. So we have this smug phase where we're perfectly hedged, so we're one short and one long, and if we think the market should be going up, so let's suppose we have a long perception because of the way the modelling is, and then the market starts to go down, so the market's going down, then we're in this sort of smug phase. Yes, well, that's all very good, but we're not actually really effectively trading. All we're doing is sort of testing the market. Then when we get to the point where we say, right, okay, enough is enough, we want to actually get into the trade on a long bias. So we go short one unit and we go long 1.2 units. So we've got a 20% or 0.2 long bias in this case. Now, whereas before the default trader would have well, arguably they'd have been in here, but let's assume that they came in at the end of our smug phase, which is possible. Then they'd be 1 unit. They'd stick their 1 unit long there, and we're actually sticking 0.2 of a unit long because we've got a 20% bias. So what we would do if we don't forget, we've been monitoring the market and getting a feel for the market in this smug phase, and if we were still convinced that the long strategy was correct and that the market was actually just overstretched, it was fighting the metrics on the way down, as we call it. It was going down, but with the air, with the air brakes, with the air brakes on and the flaps fully pushing, so that we're going to stall out of this dive, hopefully. Then we'd say, well, we'd be looking to get in maybe up to 3 times positions here on single positions as the market spiked down. So we'd be looking at doing this really. So we'd be long 1.2. So we'd end up still effectively 20% long, but we'd be giving ourselves a scaling potential, and we wouldn't wait for too many points. These would be quite tightly packed. Now, if we got this, if it started to go against us, we'd be losing at a lesser rate than the standard trader. So I know we'd still be losing, but we'd be losing at a rate that we can handle. And then once the market had started to give us the signs of its going up, we wouldn't wait for it to go up too far. We would then probably stick in another, probably up to a maximum of another 2. So we'd end up with five trades, the initial 3, and then the final 2, which would give us effectively a 20% bias still, but on a bigger series of trades. So we'd get round it to a certain degree by allowing ourselves the time and the swing to get into the trade from the smug zone, and also the fact that we wouldn't be waiting for this perfect situation here where the market's probably risen 20 or 30 points. We'd be filling our boots much earlier than that, because we would have basically decided that enough was enough. And this is very important because getting in, waiting, arguably is the sensible thing to do, but getting in terms of scale, so that you feed your trades in at a much lower level, really pays dividends once the market starts to. And this is where the experience of running this smug phase through the models comes into its own. And whilst that's not a perfect answer for other traders and new traders who don't have that ability, it's actually a better way than going sort of all in here, waiting for a decent pullback, and then if you get this secondary pullback carrying on, you've completely had it. And if you get up to here, it's even more annoying because you're in 2 or 3 trades. So that is our way of sort of circumventing the problems of scaling. And we're also not too greedy. Once we've got in, you know, and the market's moved down from this, you know, in this zone, from the smug zone into our sort of trading zone here, then we're not actually greedy, in the sense that we're not interested in getting entries much higher up. We're saying, well, hopefully we're in with suitable swing. If you remember the dustbin on previous videos, we've got our trade rattling around in the market. It's got a 5-to-1 sort of negative leverage on it, because we're only 20% long. So every 5 points the market goes up, we only get 1 point. But more importantly, every 5 points the market goes down, we only lose 1 point. So we're nicely in, and our trades are clustered sufficiently tightly so that we avoid this sort of situation where you're having to, like, basically make perfect scaling trades on pullbacks and retracements, and that in a nutshell is how we overcome the problems of scaling, and the other side of it is why scaling is so difficult for most traders. So I hope that helped, and thank you very much. Watch out for the next technical issues video in the series, and thank you.